Welcome to ECNTRADE Daily Video. Before we begin, it should be noted that any advice is of a general nature only and that your personal circumstances have not been taken into consideration.
Hello everyone, my name is Rob Clayton and thank you for joining me. Well, on Tuesday, surprise or no surprise, many may be asking after the Reserve Bank of Australia surprised the markets by raising its interest rates by 1/4 percentage point, taking the cash rate to 11-year high around 3.85%. Many economists had forecasted a pause. However, from the release, the market did find momentum for the Australian dollar, but ran into somewhat a bit of trouble when it got close to the 60-day moving average, which was seen around 67.2025 and staged a modest retreat. However, in light of the technical pattern, we should not abandon this topside level for a re-challenge and therefore could see anywhere from 67 to 67.25 as a potential challenge into the coming session, as eyes now turn to the US Federal Reserve, which is expected to hand down a 25 base point rate hike. But following the meeting, which is at 4:30 a.m. Sydney time on Thursday, the market will be closely watching Jerome Powell when he takes questions and answers following the rate announcement. If we do see a 1/4 base point rate hike, this would take the US rate to 5 to 5.25%. So looking at the technicals, the top side level, as I mentioned, seen around 67.25, and any pullback should find support around 66.35 on the day. The euro was a little bit mixed, but however found good support in front of that key level of 109.25. The initial move was on the back of a slightly weaker US job opening data for March, which slipped from 9.97 million to 9.59 million. Our eyes now looks to the ADP non-farm employment change. Along with that, we also viewing the ECB with a 25 base point rate hike this week. Still, we have the non-farm payrolls report also on Friday, with the expected release to be weaker than March. The March release was around 236,000, with the April looking lower, around 180,000. So therefore, the dollar index may be a little bit mixed as it eases from the highs of 102.16 overnight and now settles around 101.66, which has helped the euro push on to the top side and reach 110. I feel any movement towards that 110.60.75 area should fail, and therefore eventually see a pullback towards that base at 109.25. Dollar yen performance hit the brakes quite close to that 138 key level after the disappointing US economic data weakened the greenback, showing the US March JOLTS report, which showed the employment opening tumbled, as I mentioned earlier, to around 9.59 million, well below expectations of 9.64 million. And also the lowest since April 2021, which is a sign that the US job market is softening. So all eyes on the non-farm payrolls for this Friday. Looking at the current pattern, the pullback is now somewhat weak and therefore may see a move to 136.40. A break beneath there would expose 135.70, but I'm not abandoning the topside challenge as of yet, as the technicals are still positive. This pullback could be an opportunity for market bulls to add or re-establish positions for the next move, as beyond 138 looks towards 140 to 142. Sterling is also a little bit weaker into the second day, but still comfortably holding around the 124.75 level, with the supports viewed around 124.15.20. Could see a bounce back towards that top side of 125.60.70. It would seem that the market found a little bit of safe haven demand overnight, and gold rallied on to highs around 2015-16. The safe haven demand was ignited as news sources reported US Treasury Secretary Janet Yellen sent a letter to the Republican House Speaker Kevin McCarthy, warning him that the US federal government could hit its spending limit by June 1 if Congress does not raise the debt ceiling. This did put a little bit of a weaker play into the US dollar. Still, technically, I would like to see a little bit more of a convincing technicals from the both MACD and RSI to support a further rise. So this could be just a short squeeze up towards the region of 2032 and then take another tumble back towards the bottom side. So I'm not abandoning the level around 1,958.64 area as of yet. And also with the news of the recent debt default potentially happening, the market has found weaker in oil and tumbles further, crushing the level that was seen around 72.50. Now, I'm neutral at these levels due to the uncertainty in where we actually may head. However, for those trading, we could still see a slightly weaker play, that is towards 68, 80, 90, and then would see the technicals oversold and potentially see a rebound. Well, that's a wrap for today. Thank you very much for joining me, and as always, look out for the intraday report, and I hope you enjoy the rest of the day.